This is part 2 of the 14 mistakes beginner to intermediate options traders make. Next is mistake number 4. In this clip, I will show an example of how this mistake is made.
How's that going to affect your strategy? Surely it's not going to work if the market crashes.
You know, Jeff, it's funny you should ask that. I'm already betting both directions with this new strategy. I am benefiting right now when stocks go up, and I am benefiting when they go down. So it's well diversified. It wins in all markets. Since I got beat up so bad in Q1, wrong on, I was short everything in January and everything went up. And then I was long everything in February, and that worked for a while until it didn't. And I've really settled into higher probability trades, smaller positions, less risk. You could start with as little as $1,000. And if you're hitting 50% returns, it wouldn't take many trades to get to that coveted $25,000 day trade. Crush it. That's how I made somewhere between $200,000 to $250,000 when I initially launched this service. Then I gave it all back and then some. Wide variety of reasons as to why that happened.
This is the next evolution of trading services overall.
Yeah. I was unsure, or I'm just a little bit fragile. Here's what Windfalls is. And it is revolutionary. It's unlike anything you've seen. So I'm kind of settling into where do I want to live? I think I'll get back to selling more risky trades at the money at some point in time. I'm just not there yet. No one can ever project how a service is going to deliver.
Mistake number 4 is not backtesting your trade system. The system should be looked at through all the worst case scenarios first, then ran through the entire market. For example, when I have an idea, the first thing I do is run it through the crash markets like August 24th, 2015, February 5th, 2018, and March 2020. If it survives the crash, then I take it through the fourth quarter of 2018, the grind down market. Then if it's okay after that, I take it through the first 6 months of 2015, which was a sideways market. Then finally through a bull market like 2017. If it makes it through all scenarios, then I backtest the last 10 years. If Jason Bond would have backtested his system through August 24th, 2015 and February 5th, 2018, do you think he would have known his system was a loser? Yes, he would have known. Would he have still sold it for $1,500? Probably. If you backtest the system and find it does not work, would you put your hard-earned money into it? I say no, but I see countless beginner and intermediate option traders trading a system that they've never backtested. Next, I will go over mistake number 5, and this is trading without a concrete plan, or what I call subjective trading, or changing the trade rules as you go. Now, as I studied Skyview trading, I found that they follow rules very similar to Tasty Trade. And they like to sell premium, and they wait until the IV rank is relatively high to open a position. They also have rules about keeping the position size down to 5% of margin available in the account. And when I looked over the alert service, I found that the margin being used in the account, in their alert account, was 33%. Because they did not even follow their own trade plan. They had to break the rules during the 2020 crash. Rather than following the game plan of adjusting positions, they had to close positions and take losses. I also remember taking the course and following Dan Parker and TrueTrader.net, and he specifically stated he only traded the first 30 minutes to 1 hour of the trading day. But when he was in a loser, he would hold it until later in the day, hoping it would come back. He also stated that he never held stocks overnight, but I watched him hold several stocks overnight. He also said he would hold a position with a certain risk-reward parameter, for example, like a risk 1 to make 2. But he never took losses at a certain point, and he never held a position long enough to make all of the money that he had claimed he was going to go after. These might not be the exact rules that Dan used, and the reason why I don't know the rules is because he never followed any concrete money management rules. Sometimes he would take profit after a 10-cent move, others a 40-cent move, And I think maybe once he held for a full 1 point or $1. The point is that he did have rules, but when it was convenient, he would change the rules. He was trading subjectively and changing the rules as he went along. If you change the rules as you go, how can you backtest the system? If you don't have rules to follow, you won't gain any consistency. And changing rules as you go is a rookie to intermediate options trading mistake. It is mistake number 5. And it causes the account to draw down without any potential type of consistent recovery in place. Next is mistake number 6, not understanding liquidity, slippage, and trade execution. Now, liquidity is required when trading options in order to prevent a costly mistake of paying too much for slippage. And this can happen by choosing the wrong underlying or by bad trade execution. And next, I will explain the liquidity concept in terms of the underlying asset, and then I will go over the importance of trade execution. My goal is to go over these concepts in order to create a better understanding of what they are, and hopefully I can help the beginner to intermediate options trader do their best to avoid these pitfalls. Number 1, liquidity. I call this the liquidity pitfall. When liquidity is absent, the cost is higher to purchase and sell an asset. When there's a lack of liquidity, extra costs occur and they're called slippage. Here's an example. If you were to buy a $200,000 home, you would have fees. So you have all these fees would come out when you're purchasing to around 2%. And then when you go to sell the home, you have fees. So when selling, you've got around 0.71% or somewhere between 0.5% and a full percent. That does not include commissions. So basically, when you buy and sell a home, you're looking at somewhere between 2.5% to 3% just on slippage of getting in and out of that piece of real estate. Now let's talk about slippage with stock. We can use IBM as an example. So here's what IBM was trading at the time when I created this presentation. It was trading for about $132.38. That would be your purchase price. Let's say that you wanted to get out of it right away. You decide, you know what, I really don't want to hold this stock. I'm just going to sell it right away. Your sell price would be $132.37. So you would lose about $1, and you're dealing with 100 shares of IBM, so you're dealing with around $13,000. So you lose $1 and you have $13,000. I mean, that's just insignificant slippage. In fact, it comes to 0% basically in slippage costs when you trade in and out of a stock, if it's a liquid stock like IBM. Now we can look at IBM options. So the 135 call, you would buy the call, let's say, for $5.10. And let's say, oh, you know, I made a mistake, I want to get out right away. Well, you're going to have to sell that back for $4.95. You're going to pay $15 in slippage. That comes out to almost 3%. So the cost and slippage of coming in and out of an option on IBM is around 3%. So how do you mitigate that? I mean, you can see that there's problems with liquidity with options. So how do you mitigate that? One way is to trade extremely liquid options. Some of the most liquid options you can find are on the SPX, which is like the S&P 500. So this example, you're dealing with a 28.35 call, and when you go ahead and buy that call, you're going to pay $95.70. And let's say you want to get out and you want to sell it right away, you're going to sell it for $95. So you're going to take a 70-cent loss on that particular option. So you're dealing with around $10,000 and you're losing around $70. So that comes out to around 0.7%. So it's very low compared to the, probably I would say the norm, around 3%, but it's not anywhere close to where when you're just coming in and out of a stock.
The second advantage that stocks have over options is trade execution. For example, when you're buying a stock, it's a very simple transaction. Much like buying a pair of shoes, you simply give your money and you receive a pair of shoes. When you get in and out of a complex options position, it's a lot more complicated than that. Price can actually change while you're in the middle of your position. Let me use real estate again as an example. What can happen in real estate is you could be in part one of the transaction where you could be purchasing a piece of real estate and you do your due diligence and you inspect the property. You find maybe that there's something wrong with the foundation. Now, the amount of money that you were originally going to pay for that property has now come down in the middle of the transaction. You have part one, and then when you're getting to part two, the closing or the end of the transaction where you're going to actually finish paying, the price changed in between there. It's very similar for a complex options position. What makes an options position complex? Well, it has multiple parts. So you could execute the first part of the trade, and then the market can go up or it can go down before you can get the second part of your trade off to complete the whole position. How do you mitigate the risk when it comes to a complex options position? What you want to do is eliminate the time that it takes to put on your position. If there's any time lag in your position, that's where you have risk. So that the answer to that is to create a position that only requires a single ticket order. Now, what is a single ticket order? It's basically being able to put on a full position, an options position, all at one time in one trade, rather than dividing up that position into little pieces and putting it on piece by piece. You put it on all at once in a single ticket order. If you use a single ticket order, you eliminate the risk of trade execution.
Now, part two of what you should know about trade execution is how to work the order. You want to start with a limit order, not a market order. And there are plenty of places to learn about what a limit order is, and you can just Google that. But now, you want to place your limit order well below the actual price that you want to pay, and then slowly work your order up towards the real price you're willing to pay. And that's called working the order. And here's an example. And this is a trade I placed for my 5-step options trading success program. Now, this one here, I want as much of a credit as I can get. Right now it's telling me it's going to get me around $40.10 or $48.20. I'm going to, I'm not taking any chances on this trade execution. I'm going to bring that way up here to like some kind of crazy number that they're not going to fill, like $40.80. If I get $40.80, I'll be happy. So I'm going to right click, hit confirm and send that in. Now, if I go to monitor, you can see that these two are up here. They're working. This one's nowhere close to be filled, and this one's nowhere close to being filled. So I'm going to work this order down until it fills. I don't know what price I'm going to get for this. I'm just going to keep going down until it fills. Right now it says the mid price is $40.10 or $40.15 or $40.05. I'm probably not going to get that. I'm probably going to get a worse fill than that. Let's see what happens. So I'm just going to bring it down. I'll go down 20 cents. 40.60 is most likely not going to get filled. And I'll just go down 10 cents at a time until I get close to that mid price. So that mid price is still around at $40.10. $40.20. Now I'm getting really close. Like I've seen it at $40.15, so I'm just going to go down by 5 cents at a time to make sure I can get the best possible fill. So here's the mid price. Most of the time you don't get the mid price. Like the market maker says there's the mid price, but they really don't fill there. They want to make a little bit extra off of you. And that mid price is not totally accurate all the time anyways. Okay, so there we go. That's a decent fill. You know, 40.05. I like that number, even though the mid price is maybe 40.10. So you can see that what I call mistake number 6, not understanding liquidity, slippage, and trade execution, I hope that I've explained it in a way that you can have a better understanding of what I call mistake number 6. If you're interested on how to avoid the 14 mistakes that beginner to intermediate options traders make, and how to avoid the 10 mistakes professional options traders make, you can sign up for my free course. There's a link in the description below, or you can sign up for my 5-step options trading success program, and that course also has a link in the description below.